repeatedly with not just the Trump administration, but the US government in general. The more it attacks foreign countries, the more aggressive it is, the more it's actually accelerating the search for alternatives. We saw this with the seizure of Russia's assets. The US and the EU seized hundreds of billions of dollars and euros worth of assets held by the foreign reserves held by the Russian central bank. They did this also to Iran and Venezuela, and that accelerated searches for alternatives to the US dollar. And now we have China, the world's largest economy when its GDP is measured at purchasing power parity. And now the US is threatening to do something similar to China. So China has been seeking alternatives. This isn't actually new. It actually goes back to really the 2008-2009 financial crisis. If you look at until then, central banks around the world were holding more and more US Treasury securities, that's US government debt, and they were holding them in their reserves. And then with the financial crisis, they started reducing their holdings and holding other assets, including gold. And gold holdings by central banks have been rising ever since then. But in the case of China, since 2013, 2014, China's holdings of treasury securities as a percentage of its overall reserves have been falling. Part of that is related to the US quantitative easing policy, but also it's because in 2014, the US put sanctions on Russia, and China was concerned that it could potentially be next. And of course, China was right, because the US has been putting more sanctions and export restrictions and now tariffs on China. The US has been putting them on China. So in terms of what's happening now with Trump, this has been a relatively gradual process, really until 2022. So Trump was reducing it. China was reducing its holdings of US dollars and treasury securities. Russia was doing the same. But in 2022, when Russia's assets were seized, it massively accelerated the search for alternatives, not only within Russia and China, but within many global South countries, even longtime U.S. allies like Saudi Arabia, Egypt. Their reserves their central banks are holding fewer and fewer U.S. assets and more gold. And in the case of BRICS countries in general, another major purchaser of gold is the Indian central bank. India, of course, has good relations with the U.S., but they're also concerned about this. Now, so in 2022, it accelerated further. So there are kind of a few moments here. 2008, 2009 crisis, 2014 sanctions on Russia, 2022 sanctions on Russia, and now Trump's tariffs and trade war. And this is only further accelerating the sale of U.S. assets. But in this case, it's not just treasuries, and it's not just foreign central banks. It's foreign investors, period, which honestly is really shocking, because Trump is a billionaire. He has 13 billionaires in his administration. His treasury is run by a billionaire hedge fund manager from Wall Street, Scott Bessent. His commerce secretary is another billionaire from Wall Street, Howard Lutnick. One of the top officials in his administration is Elon Musk, the world's richest billionaire oligarch. He and Trump invited the most powerful billionaire oligarchs in the world to his inauguration: Jeff Bezos, Mark Zuckerberg, Tim Cook. And now Trump's trade war policies, at least temporarily, crashed the stock market. The S&P 500, the main stock market index, fell by over 20%. The NASDAQ, which is a more technology-focused index, fell by even more. Some of that's recovered, but it's been very volatile in the stock market. Every time Trump announced tariffs, the stock market falls. Then he announces a pause, then it goes back up, and it's been very choppy. So this has resulted in a lot of volatility. And then when Trump declared these massive tariffs in countries around the world, there was a revolt in the bond market. Trump's officials have made it very clear they really want to bring down the yields on U.S. Treasury securities, especially the 10-year note. So when the U.S. government runs a fiscal deficit, it sells bonds, bills, notes, and bonds in order to finance that deficit. And the U.S. government is very concerned about the 10-year yield in particular, because many other rates in the U.S. economy are set based on the 10-year yield. So the mortgage rate, the 30-year mortgage rate in the US is usually about 2% higher. There's a different spread. It changes over time, but it's, sometimes even higher, up to 3% higher than the 10-year Treasury yield. Right now, the 10-year Treasury yield was getting close to 5%, which means you have 30-year mortgage rates of 7 to 8%, which obviously makes it very hard for Americans to get a mortgage. It's very expensive. Furthermore, you have other loan rates like auto loans, credit card interest rates. They're closely related to the 10-year yield. That's part of it. But then also a major concern is that the U.S. government has, right now, it's paying out interest payments that are 3% of GDP. Now, MMT people correctly point out, modern monetary theory people correctly point out that a country that that can print its own currency can't go bankrupt in its own currency. However, I think they often downplay how much inflation can be caused because, the U.S., it's true, the U.S. can't go bankrupt from its own debt. Right now, U.S. debt is 120% of GDP, but the U.S. has a lot of inflation. A lot of that inflation is because the U.S. deindustrialized and can't produce anything, so it has to import everything from abroad, and the supply chain shocks due to the COVID pandemic caused significant inflation around the world, these disruptions. And now Trump is further disrupting supply chains, which is going to cause more inflation in the US. And he wants to reindustrialize, which is not going to happen. But if he actually tries to do that, it's also going to be inflationary. And he's deporting immigrants, which is also going to be deflationary. So all of these policies are deflationary. And the U.S. has this very high debt, which, yes, okay, it's true that the U.S. could basically just, metaphorically print money to pay off this debt, but it would run very hot inflation if it did that. And inflation is the main reason that Trump won the election, because a lot of voters blamed the Democrats for the inflation. I mean, the inflation was global, but most incumbents who were in power in 2022 during the inflation crisis caused by the pandemic disruptions, most incumbents lost power in elections. So inflation is a very important political issue for U.S. politicians, because if they don't contain inflation, they're going to lose the election. Trump knows that. That's really why he won. The Washington Post and Pew did studies that found that around 2/3 of voters in the U.S. said that the economy, and in particular inflation, was the most important issue in the 2024 election. So the Trump administration is in this situation where they do have this very high debt, which, yes, the U.S. government can't go bankrupt on its debt. But when they're running interest payments of 3% of GDP because the Fed raised interest rates, they're paying so much now. They're paying almost the same level on interest payments as they pay on the military. And the U.S. military budget is as large as the next 9 largest military spenders in the world combined. And now Trump says he wants to increase the military budget to $1 trillion a year. But Trump says he wants to reduce the deficit. So what's the best way to reduce the deficit? They want to bring down interest payments on debt. Well, in order to bring down interest payments on debt, they need to reduce interest rates. How do they reduce interest rates? Well, a few different ways. They could cause a recession. And some people have been speculating, and it's very possible that the Trump administration wants to orchestrate a recession, because they know that average working people will suffer. Millions of people could lose their jobs, but they can bring down interest rates, which means that the yields on 10-year Treasury securities would go down, which means that interest payments would go down and inflation would go down. Because in a recession, people lose their jobs, they don't have money, they don't go out to eat, they don't buy things. Those companies, those businesses lay off their workers. You have this spiral where inflation falls down because people don't have any money. So that's one possibility, and it looks like it's a very real possibility that the Trump administration may try to do that and then blame Biden. They'll say, well, this is the Biden economy. They want to do it soon, certainly before the 2028 election, but also before the midterms, right? Which, U.S. elections happen every 2 years. It's crazy. I mean, it's just constantly keeping us trapped in this charade where we pretend like U.S. politicians represent people, and actually it's just a bunch of billionaires buying them off. But, in the case of Congress, over 80% of candidates running for the House of Representatives who have more funding win, and over 90% of candidates who have more campaign contributions win. So, it's the best so-called democracy that money can buy. But getting back to the bond market. So I've explained that the problems that the U.S. has this conflict where, Japan, for instance, has debt of over 200% of GDP. But the reason that it hasn't been a problem is because inflation in Japan has been almost zero for like 30 years, ever since the Plaza Accord, in which the U.S. overvalued the yen and crashed the Japanese economy because it caused this big Japanese asset price bubble that exploded. It popped in the early 90s, and there was a lost decade, and Japan has been stagnant and has had very low rates of growth, but also very low inflation. So the debt isn't a big issue. In the U.S., there were very low rates of inflation after the 2008-2009 crisis because, a lot of working people they had stagnant wages. And, when the economy is pretty stagnant, when wages are not growing, it's easy to have low levels of inflation. Also, China was exporting deflation to the U.S. in terms of low cost consumer goods. And now the U.S. with all these tariffs is going to have much more inflation because we no longer have the cheap goods from China. So the point I'm getting at with all these details is that the U.S. government is in this contradiction. The Trump administration, they want to bring down interest rates, but inflation is going to be a persistent problem. It's not just the 2022 supply chain shocks. It's here to stay. It's like the 1970s. So they need to find a way to deal with this. But usually, this gets back to the issue of de-dollarization. So I kind of went off on a trail there, but it's all related. The point I'm getting at is that the bond market is what the Trump administration is really concerned about. That's the main reason why Trump paused those tariffs for 90 days in many countries, because the bond market was revolting. And if Treasury yields get too high, it's going to cause a crisis in the U.S., like what happened with the British conservative prime minister. If you remember, Liz Truss was prime minister for like 1 month, and then she introduced this budget that was like this insane Thatcherism with huge deficits that were not financed by taxes or anything. The bond market revolted and she was ousted. So Trump was in a kind of similar Truss moment, right? And the reason I mention all of that is because it's important to understand this, because what it shows is the weakness, the Achilles heel of the U.S. economy. Because almost always when the stock market crashes, the bond market will rally, because investors will engage in what's known as a flight to safety, because their stock prices are going down. They sell their stocks and they want to put that money somewhere. So they panic. And what was seen as the safest investment was U.S. government debt, U.S. Treasury securities. So almost always in previous crises, when the stock market falls, bond yields fall because investors buy more bonds. And that means that the price of current bonds that have higher yields go up. And then as the yields go down, it makes the borrowing cost of the U.S. government lower. However, in this crisis that Trump started on the 2nd of April, we saw the opposite happen. The stock market crashed, and the bond market crashed. Bond yields went up. Bond prices went down of existing bonds. That is a serious sign of a major problem, a structural problem. And I'm not saying it's going to cause another 2008 financial crisis, but it could cause a serious economic recession or some kind of crisis in the U.S. economy, because what we're seeing is actually massive capital outflows. The U.S. economy has been basically barely surviving in recent years after the 2008-2009 crash. It's been barely getting by through a big bubble, what people call the everything bubble. There's been a bubble in stocks, a bubble in real estate. There was until recently, 2000, because of the COVID pandemic, until 2022, when the Fed raised interest rates, there was a major bull market in the bond market for years. And so now what we're seeing is that foreign investors are simply getting out of U.S. assets. And that was really the only thing keeping the U.S. economy going, is this big bubble in financial assets and the stock market and the real estate market. So what we've seen is that because of Trump's threats of tariffs and the volatility, a lot of investors simply don't trust U.S. assets, period. because they say, okay, the stock market fell 5% yesterday. It'll go back up 2% today. It might fall 5% tomorrow. It might go up 5%. It's so volatile. They don't want to deal with it. They'd rather put their money somewhere else. So what we're actually seeing is that this is the real constituency of the U.S. government. This is why the Trump administration is they have the fear of God in them now, because they don't really care about working people. Their real constituency are the billionaires on Wall Street and billionaires in other countries, the global capitalist class. And they're now doing a capital strike. They're saying that the U.S. is no longer a reliable investment, and they're looking for the safest investments which they can find, which ironically is actually like Swiss bonds, German bonds. The European stock market has been rallying. So this was the only thing that the U.S. economy really had going for it anymore was Wall Street, and then of course Silicon Valley. China is creating alternatives, competitors to Silicon Valley monopolies like DeepSeek, and now Wall Street is in crisis. So the reason I'm going so much into all these details is that what I'm trying to get at is that the U.S. government thinks that it's so powerful and everything in the world revolves around the United States, and other countries have no alternatives to the dollar and no alternatives to Wall Street and no alternatives to U.S. Treasury securities and no alternatives to big tech corporations in Silicon Valley. But increasingly, there are alternatives. And the more aggressive that Trump is, the more he's actually destroying all of the exorbitant privilege that the U.S. had and all of these institutions that were keeping the U.S. economy afloat and popping the bubble in Wall Street that made the economy look in the U.S. like it was doing well, because as the Wall Street Journal recently reported, 1/3 of U.S. GDP comes from the spending of the richest 10% of the population. The richest 10% of the population represents nearly half of spending in the economy. So if their wealth begins to decline because of these crises in the U.S. capital markets, this is going to cause a cascading series of crises throughout the U.S. economy. And that's going to further de-dollarization, because one of the reasons that so many foreign capitalists held their assets in U.S. in the U.S. capital markets is because they always assumed that the U.S. dollar would be strong, because the U.S. dollar is the global reserve currency. They always assumed that the U.S. government would always do whatever it takes to protect Wall Street, as what is known as the Fed put or the Trump put, which means that if there's a fall in the stock market, Trump will step in and save the stock market, or the Federal Reserve will step in and inject liquidity, reduce interest rates to save the stock market. But what we're now seeing is simply a flight out of U.S. assets, which is why even Deutsche Bank, the major German bank, is warning that U.S. assets in general are no longer seen as attractive to foreign investors. So if they continue this capital strike, the U.S. is shooting itself in the foot on trade, shooting itself on the foot in terms of its exorbitant privilege with the dollar, and accelerating de-dollarization precisely at a time when Trump is telling countries that if they de-dollarize, he's going to put 100% tariffs on them. But now countries are saying, fine, we already have tariffs on us. We might as well de-dollarize.